Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Repco Finance, hosted by Yes Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajiv Mehta from Yes Securities. Thank you, and over to you, sir.
Yeah, hi. Good afternoon, everyone. Thank you for joining on this call. We thank the management for giving us this opportunity to host first quarter FY23 earnings call of Repco. We have with us Mr. K. Swaminathan, MD and CEO, and the entire senior management team. Without much ado, I would invite Mr. K. Swaminathan to start the proceedings with initial remarks on the company's performance, post which we'll open the floor for Q&A. Over to you, sir.
Thank you, Mr. Rajiv. Welcome to everybody. Good morning, good evening, wherever you are. Welcome to this conference call for the quarter ended June 30, 2022. On behalf of the company, I extend a warm welcome to all of you and thank you for joining us. See, I would like to recall whatever we said 3 months back, wherein we expected that the company would get back to its growth path. I'm happy to announce that after 2 subdued first quarter performances in the last 2 years, maybe because of COVID, but we have reported strong performance in the June quarter and have started this fiscal on a positive note. Business activity has picked up handsomely, with the loan sanctions and disbursements returning handsome sequential growth. Loan sanctions have increased 6% sequentially to about 692 crores from about 652 crores, and disbursements have increased 7% sequentially to about 642 crores as compared to about 601 crores in quarter 4 of 22. Though not strictly comparable in view of COVID situation last year, loan sanctions and disbursements registered an exponential growth of 236% and 168% respectively as compared to Q1 of last year. The loan book, however, has not moved much owing to high prepayment for the most part of the last 12 months. I'm happy to announce that our well-directed efforts have caused the total repayment rate to drop 3% sequentially in the first quarter. The annualized repayment ratio, including regular repayments, which stood about 21% in Q4 of 22, has moderated to 18% in Q1 of 23. We would try to maintain this ratio at similar levels going forward. On the profitability front, we reported loan spreads of 3.3% and 4.6% above our guided levels of 3% and 4.3% respectively. On the interest paid, there has been a sequential reduction due to retirement of a few high-cost borrowings. However, the reported yield fell sequentially as our concurrent focus on growth and asset quality made us to take a couple of business decisions, which caused a sequential drop in interest income owing to a ROE reduction. The two because we wanted to retain some good quality customers. We have waived some penal interest in some cases in case of NPA accounts. We have offered some concessional fees to acquire new customers. In addition, the recoveries in technically written off accounts were lower in the current quarter as compared to the March quarter. Our stage 2 assets have also come down sequentially. That is a positive point, which implies that there is a lower penalty generation as well as penalty appropriation. However, the lending yields have not fallen much and will go hopefully in the subsequent quarters. Average yields in the book have fallen from 10.3% to 10.23%. I expect the spreads and the margin to remain higher than our guided band in FY23. The profit has grown 93% year on year to about 62 crores as against 32 crores in the previous year. The GNPA, the gross NPAs, have declined about 60% to 6.4% sequentially. The NNPA has fallen by 70 basis points and now stands at 4.2%. GNPA provision coverage registered a 5% sequential improvement to 37%. Overall, ECL provision remains steady at about 4% of the loan book. In addition to our stage 3 provisions, we also have made a provision of 20 crores to meet any requirement on account of slippages in restructured books. These provisions are floating in nature and will be utilized to make asset-specific provision in the subsequent quarter. The restructuring window on OTR, one-time restructuring assets, have got over in Q1 FY23, and regular billings have started for these accounts. The asset quality outcomes will be known in Q2 and thereafter. The said assets are in stage 1 or stage 2 now. We are trying our best to minimize the slippages to NPA and will give you an update in the next call. As far as earnings are concerned, we earned an ROA of 2.1% as against 1.6% last quarter and an ROE of 11.9% versus 9.6% in the Q4 of 22. The recovery in return ratios was attributable to improving business performances as well as lowering of credit costs. The balance between our exposure to self-employed and salaried segment stood at around 51% and 48.8%, more or less at the same levels. The share of non-housing loans, that is LAP, that is also more or less at the same level and is around 19.4% of the loan book. Cost to income ratio stood at about 23.9% in Q1. The capital adequacy ratio is comfortable at 34.2%, of which Tier 1 was 33.2%. Our retail network is comprised of 158 branches and 22 satellite centers. As stated earlier, we have resumed our network expansion. During the current quarter, we are doing some surveys. Hopefully, there will be some new branches opening or new satellite center opening in the third or fourth quarters in the coming year, in the current year. Liquidity continued to remain comfortable for us as we have carried around 275 crores of cash and cash equivalents at the end of June 22. In addition, we have around 1,900 crores of unutilized lines of credit. Now I will summarize for the happenings of first quarter of June 22. One, the loan book has stood at 11,862 crores, registering a 1% sequential growth. PAT has surged 93% year-on-year to 62.1 crore, and sequentially the growth is 48%. ROA and ROE stood at 2.1% and 11.9% respectively. Core profitability has remained strong with a strong spreads and margins of 3.3% and 4.6% respectively. NPA stood at 6.4% with a coverage ratio of 37%. With this I conclude, and I hope we are all, the entire management team is ready to answer any of your queries. Thank you, Mr. Rajiv, and as well as all the participants.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Akash Jain from Money Curves. Please go ahead.
Thank you so much. First of all, I think we are happy that it seems that the company has finally turned the corner in terms of AUM growth as well as a little bit on the credit cost side as well. So I think hopefully this will sustain. But after, like you mentioned, after few quarters of really not so good numbers, I think finally we have seen some good numbers. So I think congratulations for the management team and especially to Mr. Swaminathan, who seems to have really picked up since he has joined. So congratulations from our side to the management team. I have a couple of questions, sir. Like always, it is always focused on two things. One is credit cost and the other is on growth. On the credit cost, I think you clearly mentioned that the whole restructured book of about 700 crores has now opened up for regular payments. But clearly any slippages will only start to reflect from Q2 onwards. But from the initial early trends, should we as investors be a little worried about, because that's a very large book, right? 700 crores of this structured book is a large book. So are there any early stage warnings in terms of slippages in that book? Is there something we need to be really cautious about? Because you have already created a 20 crore of provision, which I'm assuming is for the restructured book. But are you seeing is there any worry about slippages coming from that book?
Can I answer?
Yes, please.
Yeah. Thank you very much. See, let me be very clear. As far as credit cost is concerned, whatever we have already projected, maybe 80 crores to 100 crores for the entire year, we still maintain. As far as credit provisions are concerned, we do not think that we will be made to make additional provisions than this 80 to 100 crores that we have already provided, already budgeted. Yes, as far as numbers are concerned, I am still keeping my fingers crossed. I do not want to give any false hopes. Yes, the 700 crores are there, but we are striving our best. We hope we will be able to contain the NPA percentage as much as possible, at least to an extent of 7% or something. But I am unable to give you any clear guidance as far as the GNPA numbers are concerned for the second quarter. But as far as provisions are concerned, yes, we are somewhat comfortable. This 20 crores that we have provided is only a cushion. Actually, we have made a cushion of this 20 crores. So for provision wise, we do not think there will be an issue. But GNPA number, I do not want to give any guess as far as this credit card is concerned. As far as growth is concerned, I am thankful for the compliments made. Yes, growth is started. I'm happy to share with all the listeners. Why I'm happy is the growth has happened not just in one center or one branch. Almost throughout the country, I am seeing some momentum. Nearly some 80 to 85% participated in the growth in the first quarter, and I am seeing the momentum continuing in the current quarter as well. So as far as business growth is concerned, we are happy that this will continue in the current quarter as well. And not only that, see, even the ticket size is improving from around 14.5 crores, which was earlier. Now the present ticket size for the current quarter, I think it is ranging from 16 crores to 18 crores, 16 lakhs to 18 lakhs per ticket, which means slowly we are moving up in the ladder as far as ticket size is concerned. So average ticket size also may go gradually in the coming days. So but for the GNPA numbers, we are gung-ho about the current quarter as well as the forthcoming quarters.
So I have just two follow-up questions, more like the data points. So in the Q1, how much slippages we had? Because clearly there was a reduction in stage 3. So I'm assuming there is some slippage and some recoveries. So can you give us a sense of how much was the slippage and how much in Q1?
Yeah. Q1 slippage was 104 crores. Recovery was 165 crores.
So this 101 crores slippage, sir, that is not coming from the restructured book, but is coming outside of the restructured book.
Maybe a small amount from restructured book, maybe around 15-20 crores. I do not have the exact number because we did restructure in 2 or 3 stages. A small restructure was done earlier, which fell due in the first quarter itself. Maybe some 15-20 crores maybe of the restructured book out of this 104 crores.
And sir, I think in the last quarter you had Concall, you had guided that by the end of the year we were probably at 810 crore GNPA number at the end of FY22. And you had in your conference call said that your endeavor is to get that number to about 700 crores at an overall number for stage 3 by the end of the year, both from recoveries as well as some slippages may be there, but your effort was that you will get that 800 down to 700. Do you think that is still possible given the trends you are seeing overall in terms of slippages?
Yes, we still maintain. So let me be clear. We still maintain. We have some time for that thing. Only thing is for the quarter there is an issue. Still 2 quarters are left for the year to end. So we are hopeful we still maintain 700 crores.
So there may be a possibility that Q2 slippages will be slightly higher, but then we will have the rest of the year to do recoveries that we have done in Q1, the strong recoveries we have seen in Q1.
Yes, possible, sir.
Okay. Thank you.
Maybe
I'll reason that.
That will be recouped in the next 2 quarters.
Okay, no problem. Thank you so much.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, sir, and thanks a lot for taking my questions. So, sir, given the sort of growth that you have looked at in the first quarter and in the current quarter, is there any updated guidance on where we want to reach in terms of FY23 and loan book? I think in the last quarter the expectation was around 13,000 crores.
We maintain, sir. See, we expect a growth of 10 to 11% in the loan book. We do not want to change as of now. We still maintain 13,000 crore loan book by FY23.
Understood. And the credit
if there are any changes in the next quarter.
Okay. But as of now, you feel confident that we can reach there?
Yes, sir. I'm optimistic.
Understood. And this 80 to 100 crore credit cost guidance, this includes the sort of floating provisions that we have created of 20 odd crores this year, right?
Yes.
Understood, sir. Sir, on the other side, I was looking at your employee cost, etc., and that also has been fluctuating a lot on a YOY or QOQ basis. So are there any, initiatives on the cost side, especially the employee cost side that we were planning earlier, which we are planning to bring from the current quarter, which will have an impact on your cost to income?
We had budgeted an increase in employee costs. If you recall, I think even the first call we had told, there may be an increase in employee costs overall because the salary division is due. We are also going for some recruitments and all that. There will be an increase in the employee costs in the current year. One. If you see year on year, there is an increase in employee costs only because the previous year, the first quarter, there was more work from home and all that. So employee costs and the travel expenses for employees were less, and salary encashment, things like that were less. So technically, it's not comparable. The employee costs between Q1 of FY22 and Q1 of FY23 is not all that comparable. In fact, there is a small reduction from sequentially in the employee costs. Around 2 to 3 crores, there is a small reduction. But going forward, there may be a small increase in the current quarter, as well as a bigger increases in the next 2 quarters, because some salary revision is also due. But hopefully, the increased anticipated income will take care of all this.
Understood. And finally, on the repayment and prepayment side, so I understood you gave some comments in the beginning, but if you can throw some more light, so one, of course, is we are trying to not let go of our good customers, so maybe we are reducing the yields for them, and that might be one of the reason why your prepayment has come down. But what are the other sort of the things that you have done in this quarter? And if you can guide on, this annual repayment, you said 18%. So does it include all the sources like prepayment as well as scheduled repayments, which is included in this 18%?
Yes, this 18%, whatever was said, it includes everything. It includes the normal repayments, some bulk repayments being made by our existing customers, normal closures of the account by our existing customers, as well as the last is the prepayment or the takeovers, this BTs. All these are included in this 18%. This is one. Second, this percentage is coming down. That is, prepayment or the takeover percentage is coming down sequentially. Hopefully, we will be able to maintain that downward trend in the coming quarters as well. So many activities are being done. One such thing is giving an interest concession wherever warranted, wherever we feel that there is a requirement to retain that customer. That is one. Second one, we have taken up with CIBIL also to see what best, wherever our customers are approaching other institutions for any of the facilities and all that, so that we get a warning and we ask our branches to contact these customers to see that he can leave as much as possible. This is second. Third one, we have started maintaining contact with all our existing customers. Even though a customer might not have been given facilities by the present management of the branch management, still he has been asked to maintain contact with even existing customers so that the relationship is built. So any new requirements of the existing customers, our first call will be our company. So with all this, we expect going forward the BTs to come down.
And on the parallel side, on the liability side, are there any initiatives, for example, increase in the NHB exposure, etc., that we are doing which can help us sort of retain the spreads that we were having last year?
See, we take a commercial call, whether it is NHB or a commercial bank or anything, we take a commercial call. Frankly speaking, even today, NHB is also increasing rate because of repo rate increases. Whereas some of our lenders, it is all priced on MCLR base. So this repo rate is not immediately transferred in our MCLR cost. So we take a commercial call whenever we require funds, whether to take from NHB or whether to take from a commercial bank or from our parent. A commercial call is taken. Overall, the interest is to see that our cost is less.
No, understood, sir. But my question was, do we have any levers?
But for any follow-up, sir, may we request you to rejoin the queue as participants are waiting in the queue for their turn. Thank you. The next question is from the line of Amnish Thakkar from Singular Gulf India Advisors. Please go ahead. Amnish Thakkar, your line is in talk mode. Kindly go ahead with your question, please. So if you have muted yourself from your handset, I request you to unmute yourself and proceed with your question. As there is no response from the current participant, we move to the next question from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. Sir, two questions. Firstly, on the yields, what is the reason for yields decline on a sequential basis, and how should we think about margin and the spreads going forward?
Okay. Can you complete all your questions so that I can answer in one shot?
Sure. So, second is, can you share the stage 2 for the number at the end of June quarter? And thirdly, what is the quantum of standard restructured book as of June 22? These are the three questions.
Standard restructured. See, the second and third question, can I get it offline because I do not have the exact numbers with me. Okay, the restructured book originally was 700 crores. It has come down. Actually, the standard restructured book has come down, but it do not have the exact number as of 30th June. Okay. This is first. Okay, sir. For your yield question, let me answer. See, repricing yield has come down not only because of our repricing of some of the loans. It is because of multiple factors. One is repricing, as I had already told. We wanted to retain some of our good customers, not to leave, so we have repriced. That is one. Second one, the penalties. For example, wherever there is a stage 2 reduction, I think you would agree, there is a stage 2 reduction number. Wherever there is a stage 2 is reduced, the penalty generation also get reduced. To that extent, repayments going towards penalties also get reduced. So our penalty income has come down in this quarter. Second, then recoveries in technically written off accounts have come down. This is one. Then we do not have any repo linked loans. So there is a lag effect between our repo revision. So this way also there is an interest income reduction. So all these factors put together, there is an income reduction. So it is not necessarily because we have given some concessions. We have not passed on the entire repo revision to our interest pricing. This is one of the reasons why interest income has come down, especially in the first quarter. We have not repriced.
How should we look at full year margins and spreads, full year margins and spreads?
I think we maintain, sir, that 4.3, right? 4.3 and 3% spread, that we maintain, sir. We will be maintaining. Hopefully in the coming quarter, this interest reduction may not be to this level, hopefully.
Okay. And yeah, sure. And lastly, on what is the aspiration in terms of ROA and ROE of the company on a steady state? This quarter we had lower margins, some impact on credit costs, but on a steady state basis, how should we think about ROA and ROE?
ROE, 2%. As of now, it is 2%, sir. 2.2. ROE 2.2, ROE is 12.
Yes, okay, so aspiration is to maintain these numbers going forward.
Yeah. As of now, it is 2.1 and 11.9 respectively, and we maintain as of now.
Okay. Thank you, sir. That's it from my side. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Subrata Sarkar from Mount Intra Finance. Please go ahead.
Hello. Yeah. Sir, I have a very simple question like will be the impact of this RBI November circular as well as modification to 15th February circular on us after September, 31st September. So do we have to do additional provisioning? If you can explain it a little bit more, since I am not fully aware, do we have to do additional provisioning regarding that, or what will be the actual impact on the P&L basically?
Oh, it's easy, sir. See, RBI circular doesn't require us to make any additional provision. RBI circular only said an account cannot be upgraded unless the entire overdues are recovered. That is, entire overdue, which means earlier NBFCs can upgrade provided the overdues are less than 90 days. That particular feature has been withdrawn. So an account cannot be upgraded unless the entire overdues are recovered. That is the only feature of this RBI circular. So earlier NBFCs, including our company, we used to upgrade whenever the overdues are less than 90 days. That particular facility is not there now. That is the only issue. But as far as provisioning is concerned, all are same.
Hello?
As far as provisioning is concerned, there is no differentiation.
Okay. So in that case, sir, we have to show higher GNPA. That is the only thing, or sir, is there any other impact on the P&L, sir? That's my only understanding.
GNP has to go up. In fact, it has already gone up. In our company, we have already recognized all these accounts in the December quarter itself, December 21 quarter itself. That is why our GNP has suddenly gone up from around 4.5 level to around 7% level. So as far as it is only because of GNP, and naturally because of GNP, the provisioning of the credit cost for those accounts.
Okay. So in our case, there won't be any impact, sir.
Impact has already been taken into account.
Yes, sir.
There was an impact that has already been taken account, but going forward, there will not be any fresh impact because of that.
Sir, pardon, sir. Going forward, whatever
is the impact because of that November 21 circular, that has already been factored in our figures. In fact, in December 21 itself, we have taken into account.
Okay, sir. Perfect, sir. Perfect. And this is a one-time.
Whatever that has taken, that will continue.
Okay. And this is a one-time impact only.
Yes.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Rishikesh from Robo Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question is if you could provide a loan book growth guidance for this year.
Okay. Second question, only one question. See, we have given a projection of 10 to 11% guidance, and the loan book of 13,000 crores. As of now, we maintain that projection, that whatever was the guidance given.
Okay. And so what is the branch growth guidance basically? So you said you will be expanding the branches. If you could give some numbers, how many branches are we looking to open this year and maybe even next year?
Sorry, Mr. Rishish, I am unable to give you the numbers, but I can tell you we have started the process. See, we have asked our people also to do surveys and all that. Once we get the reports, maybe during the third quarter, current quarter or the next quarter, we will take it up with all the places where we can start opening branches and all that. Maybe in the next conference call, we may be able to give you some numbers.
Okay. Okay, no problem. Thank you.
Thank you. The next question is from the line of Amnish Thakkar from Singular Gulf India Advisors. Please go ahead. Amnish Thakkar, your line is in talk mode. Kindly go ahead with your question, please. As there is no response from the current participant, we move to the next question from the line of Bunty Chawla from IDBI. Please go ahead.
Thank you, sir. Thank you for giving me the opportunity. Sorry if I am repetitive. Can you share the standard restructured assets outstanding as of Q1 FY22? And secondly, how much is the provisioning against these restructured has been done?
See, I do not have the exact numbers, Mr. Charla. It should be 700 minus maybe around 150. I do not have the exact numbers. Maybe offline I will be able to give you the numbers. As far as provision is concerned, whatever was the required provision as per RBI circular that we have already provided. At the time of restructure itself, we have already provided. As an additional provision, we have provided a 20 crores provision in the current quarter. Though it is not required in the current quarter, we still have made a provision of 20 crores. Going forward, we anticipated another 20 crores perhaps, that is in the second quarter. I am unable to give you the numbers as far as the likely slippages. Unless I know the likely slippages, I cannot give you the likely provisions as
well. So one clarification, just this 20 crores which you said is not included in the provisioning against restructured assets. It's altogether a separate we have done, right?
Yes.
Thank you very much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, sir. Hi. So maybe, in the meanwhile, before we have more people in the queue, I'll just kind of put across a couple of questions from my side. Sir, in terms of growth, while you have kind of articulated your target for this year, and I'm sure you're looking at even better growth next year. So besides the fact that macro is doing well, there's a lot of housing demand. So besides the macro lift, what are the operational or enabling changes that we are doing in our operations, which will lead to faster growth that which can drive growth on a more, sustainable or a permanent basis. If you can just kind of elaborate on a few important changes. It could be from an employee perspective, it could be from an operations perspective, and even from, say, more from the asset quality rigor side also, if you are trying to kind of tighten or make the operations more rigorous.
Yeah, thanks, Mr. Rajiv. We have done so many things in the system itself. One is our CIBIL score, average CIBIL score is improving. We have said as far as the quality is concerned, we will not take anything less than 550 and all that. Happy to announce that as of now, above 650, that is CIBIL score above 650 itself is more than 90% as of now. That is one thing. So quality, we have mandated that it should be maintained whatever be the growth. This is one. Then second, some simplification of process we have done in our legal and all. Earlier, there used to be a legal requirement even for any loan above 15 lakhs. Now we have made 25 lakhs, one. And second, we have made the quality also to be sure, because we have asked all our people, especially our legal people as well as our underwriting team, to visit these places to verify the properties, to verify the title deeds and on the spot, so that things become faster and on-the-spot decisions can be made. This is second. Third one, we have done a decentralization whereby some of our regions, we have 7 regions, some of our regions heads have been given powers in the current quarter, whereby the loans can be sanctioned at their level itself. It may not come up to a particular limit. It can be sanctioned at the regional level itself. It may not come to head office. Fourth, as you are asking about these quality issues and all, we have made a 2-tier structure in sanctioning in our head office, whereby a person will recommend, another person will sanction. These are all being maintained. Then post-sanction also, before the loan is disbursed, we verify whether all the formalities, all the documents, all the title deeds, and all the issues have been done. A green signal is given by head office before it is given. So once we are simplifying the process of loan underwriting, 2, we are seeing that all the processes are in place so that we do not get into any early slippages. So both ways we are doing things. We are hopeful that things will improve. And we are also improving our DSA structure. Earlier DSA used to be less. Now we have simplified the process of DSA recruitment. So that channel is also expected to give us more numbers in the coming quarters. So all these are qualitative figures, but hopefully all these will give us numbers.
Got it. Sir, what is the DSA proportion? What was the DSA proportion and where do we see it in the future?
Today it is around 18%, and hopefully it will be around 20-25% by the year end. Today it is 18%.
And then besides DSA, any other loan activity that we plan to add or any other new sales channel do we plan to have?
There is already a DSP channel that is already there. That is direct sales trainees who are our off-road employees. They are already there. That is also there. And we do not plan to add anything immediately. Yeah, we are seeing some new logins and all are improving. Hopefully going forward, once the growth starts picks up momentum, maybe we can pick up other channels as well.
Got it. Just last thing from my side before we go back to any participants. So on attrition and employees, right? So since you have come in February, it's been now 4-5 months. Have you seen any reduction in attrition at the ground level at the branches? And what are the steps?
I don't have exact numbers, but I am seeing a reduction in attrition. That much I can tell you. And I can also tell you that we have started recruiting as well, especially in areas where we have found some deficiency in numbers. So we have started recruiting. We have done an all-India recruitment during the months of April and May. And we are also even now recruiting in the local level, at the branch level or the centers where we require people. So this way we ensure that all the branches are adequately staffed, not only for business, for recovery as well. So attrition, I can say I do not have the exact numbers. Attrition, to my knowledge, has come down.
Yes. Okay, sir, I think those are my questions. And Stephen, you can go back to the participants, please.
Sure. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Geetika Gupta from ICICI Prudential. Please go ahead.
Hi, good evening, sir. Sir, wanted to check on the disbursements for this quarter. Was it fully organic or there was some portfolio buyouts as well?
Yeah, there were some portfolio buyout as well, madam.
Okay. Can you quantify it and what is the strategy behind the same?
I think, madam, see, this is one way of increasing our book. See, we made a small purchase of around 70 crores. There is nothing, it was more a commercial call. We took a commercial call. We wanted to increase and all that. That's all. And going forward also, we will not shy away from this full purchase if required.
Would it be possible to share whom did you buy the portfolio and how did you go about the due diligence?
I think I better keep off, madam. We do not want to give the commercial details. It's not fair.
Okay. But this is something that could continue in the future as well, right? That's a part of your loan growth strategy. Would that be fair to assume?
If required, madam, we will take a call depending on our requirement. If our growth book is otherwise sufficient, we may not have this particular strategy. So we will take a call depending on the requirement.
Okay. Yeah, that's it from my side. Thanks.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Amish Thakkar from Singular Gulf India Advisors. Please go ahead.
Yeah, am I audible?
Yes, sir.
Yeah, sorry. I just wanted to ask a couple of questions. One was on the ROA and ROE projections. While Mr. Swaminathan, you mentioned that you will maintain the last quarter's numbers, but given if you are expecting 10 to 11% growth and reduction in GNPA, these numbers might look very different and much improved than what was reported in Q1, because I would, as in what I'm gathering from our conversation so far, is things are only going to improve, whereas NIM and spread is going to be maintained versus Q1. So if you could maybe ask Bala and your planning team to work on the ROA and ROE projections and share it with us later on, that will be very helpful. Because my sense is it should definitely be much improved than this. And FY21 as well, the company was at 2.4, 2.5% ROA and 18% ROE.
Thanks. See, our thinking is better to be realistic than be too optimistic. So we would like to maintain the same. But one thing, we do not want to increase our credit cost beyond this 100 crores which we have budgeted. That is one thing for sure. And if at all there is a requirement to reduce our interest rate to retain a customer, we will continue to do that. One. And the spread we want to maintain at least above 3. That is for sure. All these things we want to maintain. Hopefully, because of all these things, If our yields and ROA and ROE improve, well and good.
Okay. And on the purchase of loan pool assets, as in if the underwriting and the criteria under which you are procuring these loan pools in terms of spread, and there is hopefully not enough cost and there is enough FLDG or there is some over collateralization, shouldn't you pursue this as a very focused strategy irrespective of how organic growth is happening through the branches? So the branch managers and the regional heads do have a target in terms of how much ever you aspire to grow by, which is 10 to 15% net base in net of repayments. But you can turbocharge that growth by the small pool purchase. While and I'm just complimenting you for doing that in quarter one, but it could be taken up as a sustained strategy if the risk parameters are maintained well, as in it's not diluting the spread that you want to maintain, because this hopefully will not come at any cost of managing the book.
Okay, we will look into it here. I'm thankful for your suggestion. We will take a call. Let's see. Anyhow, this pool buyout, there will be a reduction in spread compared to our branch book. So we have to take a call. Depending on, because there will be a reduction in cost also. The cost of a loan will be less in a pool buyout, cost of giving a loan. So we will take a commercial call depending on the need. But our primary focus will be on branch focused business, branch induced business.
And if I may ask, is there a specific team who's driving the loan pool buyout, or it's all opportunistic as you had mentioned, but then that does not take away focus from the business heads or the regional heads?
Yeah, it's the head office team, led by Mr. Bala as well as our accounts department.
Okay, got it.
Team only. It is not at the branch or the regional level, it is done at the head office level.
Sure. And what sort of over collateralization that you're getting, or what sort of credit collateral are you able to get in such deals, if I may ask?
Sorry, we don't have a specific number. No collateral. See, there is not any collateral. No, it's a PTT. It's a direct assignment.
Yeah, it's direct assignment. Okay, but it's a principal-only structure, but they would put some cash collateral, or there is no cash collateral or over collateralization involved.
So, whatever is the prime security, that will also get shared. So the average LTV is 41%.
Okay, and the average yield on the portfolio would be much higher than what you're paying. So the kind of excess interest also becomes like a collateral for the purchaser, right?
See, let us not get into the details of the particular transaction. See, that's what I said. See, we will take a call based on the numbers, based on the quality of the pool and all that.
And one more thing regarding ROA guidance, it is assuming we provide 100 crores during the year.
Sorry, Bala, can you come again?
Regarding ROE guidance of 12% and ROA guidance of 2.2%, it assumes we provide 100 crores this year.
Sure, correct. But this would tantamount to what sort of PAT for the year, the 2.2% ROA? You are talking about net income or profit after tax of in the zip code of 260 to 280 crores, right? For more actually.
Yes, all right. I'll give you the number. See, this is purely an estimate. We will give you the number.
Yeah, of course. So, sir, this is just an estimate. We are not holding you on to a particular number. But given the gearing has come down, that's why ROE is reducing. But my sense is from what your aspirations are, we all should be positively surprised. But again, it's just an estimate as of now.
Yes, around 275 crores.
Okay.
Around 275 crores of PAT for the year.
Okay.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, sir, just one clarification. Sir, on this, up to 100 crores of credit cost, it seems a slightly higher number. I know that the flow from the restructured asset is yet to come, but we are already holding, good provisions against the restructured assets. If I recollect, the last quarter we had built up 100 crores of provisions, and then again this quarter we have done 20 crores of contingency provision. So this 120 odd crore over 700 crore original number should have been, it looks a pretty reasonable buffer. But then you're talking about adding more buffers in the second quarter, maybe 30 odd crore. Are we kind of assessing more slippages to come through, outside of even the restructured pool, or are we just trying to be very, very cautious about the credit cost?
I say outside of the restructured pool, if at all there is any credit flow, any slippages, that will be in the normal course. We do not expect any undue slippages outside the restructured pool. Only the restructured pool is an issue which we are factoring. Outside the restructured pool, we do not see much. And hopefully this 100 crore, whatever we have provided, I think that will take care of our entire flow for the current year.
Okay. And sir, any broad thoughts on next year's credit cost? Say maybe as a percentage of average loan book, what can one assume in a normal course then?
You mean to say for 23-24?
Yeah.
23-24 should be less. I am unable to give you the numbers. So it is too early for me. But anyhow, it should be less. Fully. Seeing the quality of our present assets, it should be less.
Sure. Thank you.
Thank you. The next question is from the line of Praveen Kumar from Equitas Capital. Please go ahead.
Hello. Am I audible?
Yes. Yeah, Mr.
Yeah. Thanks for the opportunity. I just had one basic question, which is kind of a follow-up from what one of the other participants asked. Again, it refers to your ROE guidance of around 12%. What I wanted to understand was that, while that seems like a conservative kind of a guidance, at 12%, it seems like, it could be below the cost of equity, which is, expected by investors. So I just wanted to understand, because then that tantamounts to effectively, growth at that cost of equity, tantamounts to not creating shareholder value. So I wanted to understand your thoughts on that. Thank you.
It is just a ballpark estimate. See, we are also assuming that our leverage will be 4.4 times. So ROE is a function of ROA and leverage. The leverage is not going to grow year on year, although ROA will grow slightly, in fact, meaningfully. So which is why our ROE guidance is just 12%, assuming 100 crore of credit cost. The credit cost is lower, actual cost is lower, ROE will be higher, absolutely.
Okay, thank you.
Thank you. The next question is from the line of Amish Thakkar from Singular Gulf India Advisors. Please go ahead.
Yeah, sorry, I had what I was sorry, I'll come back at the questions. I've forgotten what I wanted to ask.
It's okay.
Sorry.
Thank you. As there are no further questions, I now hand the conference over to Mr. Rajiv Mehta for closing comments. Over to you, sir.
Sure. Thank you so much, everyone, for joining in this call. Thank you to the management for giving us this opportunity. Everyone have a good evening.
Thank you.
On behalf of the management, I thank all the participants who participated in this conference call. We look forward to seeing you again, hearing you again in the next quarter. Hopefully things should turn better in the years and the quarters to come. Thank you very much once again.
Thank you.
Thank you, sir.
Ladies and gentlemen, on behalf of YES Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.